Hello and good afternoon or good morning, depending on where you are. Welcome to our Tax Nuggets Academy's federal budget update for the year 2024/25. I'm Joyce and I'll be your host for today. Again, going to be an epic day today with almost 1,000 registrants. So if this is the first time event for you, welcome. And it's great to have you with us. I know it is a very busy day. It's 15th of May. Happy 15th of May to y'all. Hopefully you all got your lodgements under control. And as usual, welcome back to our subscribers, our Tax Nuggeteers. Thanks for joining us today. As usual, our chats are open for you all to engage with us, engage with each other, comments and banter in the chat. Let us know where you're joining from. As usual, I'm joining in from Melbourne. If you have a question for our instructor, please pop it into the Q&A section, which is separate from the chat so that I can look out for it as well and get our instructor to respond to you. This session is being recorded and replays are available for VIP and team subscribers. And just a bit of background for those who are new to us. Let me introduce ourselves. I'm the co-founder and CEO of Tax Nuggets. And we're here to change the way accountants do their CPD and training. So we're subscription-based, all-you-can-eat platform like Netflix, which means that you get unlimited access to all our live events. This is, for example, one of 3 that we do every week, and you'll get replays of all our previous events and resources. And this includes structured programs like our grad program and FBT program, monthly tax updates, and special topics like this one. Our instructors are leading practitioners like the one I'm about to introduce to you, and they all teach real-world skills. And you also get on-demand CPD reporting, and we don't do lock-in contracts. So if you're curious to dive deeper, head to our website, taxnuggetacademy.com.au, or just Google us to check us out. Let me introduce you to our instructor today. He is the managing director of Velocity Legal, and he lives and breathes tax, specializing in tax disputes and complex tax advice for private businesses and family groups. So please put your emoji hands together to welcome Andrew Henshaw. Hello, Andrew.
Hello.
How are you?
Fantastic. How are you?
Very, very good. It's a very busy time of the year, so thank you everyone for joining us, and Andrew as well. Is it busy for you as well this time of the year?
Yeah, it is. It is. So my background, not as an accountant, but as a tax lawyer. But yeah, it is busy because there's various stuff that's waiting on lodgements, and then we've got the end of the financial year and the budget as well. So it's a busy side.
When it rains, it pours. Because I know FBT is also due pretty soon as well.
Yeah.
So
And this year, it's sort of like Christmas and New Year's Day fell on the same day almost. We got, the post-budget analysis and the, lodgement date deadline on the same day.
yeah. Coincidentally, right? Yeah.
We're all nerds here. We can admit it. All right. Well, I don't know. Joyce, what was your thoughts about the budget?
One word. If it's a word, it's like meh. Is that even a word?
I think so.
Yeah, it was a bit meh.
There's not a lot of date. There's not a lot of things on there in terms of changes to tax laws, really. There are some things which are important to know, but it's a pretty light budget in terms of tax-related announcements. So there's the agenda there what we're going to be going through. It's a mix of few new things, some things that maybe not expected, some changes, other areas, delays to things, modifications, and some sort of revenue initiatives as well, which are not tax concessions. They're more just handouts of money and things like that. And then it's important to know what's not in there, just a bit of a stock take of issues that do affect accountants and private businesses and business owners that sort of been up in the air for quite some time. And there's no announcements or updates about those things.
So we're going to make it a little bit interesting, hopefully if you're going to, listen to us for the next hour, we hopefully make it a bit more fun. So we're going to give away some merch. So we're going to make it like a little bit of a Zoom party, Andrew. So, so we've got some quizzes and, some competition, healthy competition going on where you can win.
Interested through bribes. It's a good way. We've got the best budget hashtag, some pop quizzes that are tax and non-tax related, and a prize for the best key takeaway at the end. So stay tuned for those as well.
Yeah, so I think we will be jumping straight into a giveaway. So everybody, this is how you participate if you want to get hold of one of our merch. You saw the mug just now. It is personalized and limited edition. You can't get it anywhere else, only at, one of our live events. So scan the QR code on your mobile, or Assistant Nugget has just dropped in the link to the chat where you can participate. We'll give it a few more seconds. So this is a little bit different for those Nuggeteers that usually join. You don't usually need to put your name, but in this case, because we need to know who you are, so you have to put down your full name before you log into the quiz, so that if you do win, then we will know how to contact you.
And I'm drinking from an unmarked cup, so I might try to swing it somehow so that I can win a mug, because
yep, it's open for all. All right, everybody. Hopefully you have managed to get in there, and let's start with our first giveaway for today. All right. So first question is, how would you describe the budgeting hashtag? And keep in mind that the judge is Andrew. And so if you know him, you would put something that he would agree with, hopefully. Oh, there you go. Thank you. Lots of people typing.
Almost irrelevant. Some good ones already. Stendathon.
Free.
Calm
down. Love it. Oh, thank you, everybody. I love how engaged the audience is. Yeah, keep them coming. How to divorce. Andrew, this is a very tough gig for you. I love the alliteration as well. Have you seen any winners yet? Anyone that you go, yeah?
I've got my favorite in mind, but I'm gonna give it another 30 seconds. See if anything can beat that.
Someone has said in the chat, hashtag, I will give the answer after this webinar.
Look, I think I've made my mind up about the winner.
Okay, very good. That was quick.
And it's going to be, drum roll.
Wait, I got one.
Going to calm down. Because I just
calm down.
Calm down.
Amazing. So would you happen to remember the name attached to that?
It was very far down in the scroll.
Yeah. All good. So Assistant Nugget, I'll let you work out who the winner is with the charm down. If there are multiple charm downs, then it'll be the first person who wrote the hashtag. So congratulations to the person who did the charm down hashtag. Great. Let's kick off with the next topic.
So look, I think that's probably right. Like a lot of the comments, that there was another one that was, I'm going to write one second prize to, not even exciting for an accountant. It's a good summary as well. So, all right. But there is still some stuff to talk about. So I'm confident that we'll actually be able to talk about some things here. First up, the change about some changes that were announced last year to Part 4A, which is your general anti-avoidance rules. something that can be sort of the elephant in the room. They're not that well understood, particularly in the outside the top end of town, and it's kind of scheme the ATO can wield just very well. Then meet all the black level requirements. We're going to apply Part 4A and cancel your benefits because solely or dominantly for a tax purpose. Now, last year there were some changes announced, essentially that certain schemes that fallen outside of Part 4A would be included. There were things about getting a benefit for withholding tax and a scheme that had a purpose of reducing foreign income tax, not Australian income tax. So that was announced that would take effect from 1 July 2024. That was last year. And no progress has been made on this at all. So the announcement is that it's watch this space, and whenever, if or when this measure comes in and there's no legislation for it, it will apply in the income year after the legislation goes through. So basically parked in the maybe category, essentially.
Yep. Can I just clarify my understanding for how this would apply? So is it trying to close the loophole in Part 4A where taxpayers used to argue, hey, I didn't do it to save Australian tax. I actually did the scheme to save foreign tax. And so that's okay. Yeah. Closing that loophole.
Exactly. So, and then in the meantime, there's been a number of, or two significant cases where the Commission has actually lost on Part 4A. One was called Minerva and the other was called Mylan this year. And they were quite significant cases. So there's no mention of that at all, but it's important to note also the Commissioner lost pretty significantly on two big Part 4A cases during the year.
Yep.
So next up is denying deductions. Again, this is an amendment to an existing measure. In the October 2022 budget, you might ask, why is there an October budget? It was because that was the year in which the Albanese government came into power, and essentially the Morrison government did a budget earlier in the year at the usual time, and then the Albanese did another budget over the top of the Morrison government's budget. So it was an unusual year. But one of the announcements there was that there would be, this is something for your significant entities, so your significant global entities are talking revenue over $1 billion, and they would be prevented from claiming tax deductions for payments for IP, intangible assets, where that IP is held in a low or no tax jurisdiction. Essentially, the definition of that was a jurisdiction that has a tax rate of less than 15%, or some other highly preferential treatment for IP, for example. So the announcement is essentially, look, we actually don't need that anymore, because if you look at the 23 budget, there was an announcement that Australia would be implementing one of the BEPS pillars, which is about having a global minimum and domestic minimum tax. So essentially they said, look, we're doing this other thing. It's basically going to cover this. We don't need to have a specific measure about this. And maybe they could have done this last year when they actually announced the global minimum tax, but who knows, it might have been overlooked. So moving on, I like this picture on the right. It's not about brains, it's about tax debts, but it's about these zombie debts, which have caused a lot of issues, particularly in the media. Or it's been reported quite a lot in the media about basically the ATO got advice internally saying you have no legislative power or no power to not enforce a tax debt, essentially. And that was contrary to the ATO's existing administrative policy, where they basically they sort of put debts on hold on the basis they were uneconomical to pursue. So what basically happened is you had all these sort of zombie debts appearing, and taxpayers thinking they've been wiped off, they don't exist anymore, and then there's this debt that appears, and then on top of that, not only is the debt there, but the taxpayer was due a tax refund for 2023, and all of a sudden, no, you're going to get your refund because we've got to apply it against that debt, and we have no power to do otherwise. So if you want to read up further about this, there was an ATO about this whole debts on hold program. This announcement actually is giving the Commissioner of Taxation a legislative power to say, okay, look, you've got some old tax debts, which we're essentially going to quarantine and not recover against. But if you're due a refund, we need a power actually not use the refund to apply against that old debt. So this is for old debts. They're pre-1 January 2017. If you've got a client with one of these old debts, there will be a power for the Commission to say, okay, yeah, you're due a refund and we're not going to apply it against that old debt. This will be for individuals, small businesses, not-for-profits apparently. Small business isn't defined. It's not clear what the description will look like and what's in it, whether there be any factors, but the intention is really to come up with a solution to this issue, basically.
And in the meantime, do you know if the ATO is still going to just automatically offset the previous tax debt against the refund? Like, is it because they just have to?
I think they will have to until they've got the legislation there, because that's essentially the problem. So there's two different situations. Situation one is where there's an old debt and now you have a new debt. And essentially what they do there is they say, well, we have an administrative power not to go and recover the old debt. So that's fine.
Mm-hmm.
But the situation where you're actually due party, they say, well, you have a debt. We don't have a power not to offset, essentially.
Right.
Until they have the power, I don't think they could.
Okay.
Let's see. Watch this.
Yeah, I wonder how quick this will come out.
I mean, it should be pretty straightforward.
Yeah.
So because if it's just that the Commissioner has a discretion and it's just a wide discretion with no parameters on it, I mean, it's pretty easy to draft for that and just give the Commissioner the discretion.
Mm-hmm.
The question of how the Commissioner's going to use it, but yeah.
Great.
The next up is extension to tax compliance programs. The headline is spending money to make money. And when you look at the budget papers, these funding, so essentially the papers say, we're going to provide this extra funding for these tax compliance programs of X million dollars. And in return, we're going to expect increased revenues of a much higher figures. The old adage, you're going to spend money to make money. You're going to spend money to resource the ATO to be able to collect more dollars. So there's three different compliance programs. There are existing compliance programs that are going to be extended. It's a personal income tax compliance program for 1 year and 2 years to the shadow economy compliance program and the tax avoidance task force program. So the announcement's really just there's extra funding for these things and what the ATO expects for those. In addition to that, there's also an announcement about a counter fraud strategy and 187 million over 4 years being earmarked to fund that counter fraud strategy. And while it doesn't make them mentioned, how it's described is detect, prevent, and mitigate fraud against tax and super systems. And I think my guess is this is really targeted towards the fake ABN stuff that was happening during the pandemic. That was pushed on TikTok and social media. It was particularly prevalent in Western Sydney, was prevalent in a lot of places too, but it was was essentially, for those that don't know, it was essentially out and out fraud where persons would register that they need an ABN for some business that doesn't exist and start claiming input tax credits, GST credits. It wasn't high tech. It was marketed as get a loan from the government, where what it really was is commit fraud against the government and steal money from the Australian people. Um, so, but it was a crazy time. It was a COVID time. Money was being handed out left, right, and center. Um, uh, I'm giving people a bit of the doubt, but yeah, that's what it was. But it wasn't sophisticated at all. It was very basic. But the problem was two things. Firstly, overwhelmed the ATO. They didn't expect something of that kind of scale to happen, and their systems basically with it. In addition to that, and partly related to that, is that the ATO do have a power to withhold GST refunds, but they have to exercise that power within 14 days of the BAS. So they have very little time. And you can imagine 50,000 fake BASs come in, and it's 14 days to process the refunds. The system can't cope. So part of this measure is giving the ATO further time to be able to notify a taxpayer if it intends to retain a BAS for further investigations. 14 days at the moment, it will go to 30 days, which actually aligns to non-BAS refunds. Now, if it's the case that there's a legitimate refund that is retained over the 14 days, the ATO will pay interest on that.
Yep. But I think this will have a trickle-down effect on normal business taxpayers in that, it'll be longer to get our refunds.
Yeah,
potentially.
Well, that's the question. Does it mean now that, it's just going to be 30 days for everyone and the ATO is going to pay interest? It doesn't sound like it will be, but,
Okay.
because I think ATO pay interest on it still.
Mm.
I guess it will depend on volumes. I think it's just really giving that breathing space. So so to clarify, this is for where the ATO suspects that it is not a legitimate claim.
Yep.
This power is for, look, we've got concerns about what you put in, got concerns on whether you're entitled to what you're claiming. We need to do a further investigation.
Mm-hmm. Mm-hmm.
So moving on to personal income tax cuts. Now, these are in the budget, but they're not new because I've been talking about them for years now. These are essentially a restatement of what had come out in January, I believe, and what's already been legislated to go in. I think, cynical political marketing perspective, everyone gets a tax cut. Okay, well, it's not even in the budget. Well, not in the budget in some sense, but it's already been legislated. We've already been talking about this for a while, and it's really just addressing inflation and bracket credit. But let's call it everyone gets an income tax cut because that sounds better. So you can see there just the tables. So the difference will be the tax-free threshold still exactly the same. Then the differences will start. So the first bracket goes from 19 cents to 16 cents in the dollar with the existing thresholds. Then we've got the 32.5% rate going down to 30% and a slight extension of the bracket from 45 to 120 to 45 to 135. The next bracket is the same tax rate still, 37 cents. The difference is that it goes from 135 to 190, whereas the old was 120 to 180. And then above 190, we're at 45 cents in the dollar, plus the Medicare levy, of course. So really the differences are the 19 rate goes to 16, 32.5 goes to 30, and then there's some changes of the brackets, and the top tax rate now kicks 190%, 190,000 per annum.
Are there any changes to foreign taxes at all?
That's a good question. And something I don't know the answer to off the top of my head, but the non-resident rates, of course, are different because
Mm.
the tax free threshold, and they don't have um, the 19.
16%. Yep.
Yeah, yeah. I think they do. They are changing the 180 to the 190 still, but I think basically the ones below that is, they're not relevant, and then the rest of it will be the same as these new changes.
Yep.
Makes sense. So, giveaway time. Here, the pop quiz. It's a tax-related one. In what year was the federal income tax introduced in Australia? Of course.
Yep. Right. This must be very, very long time ago. Oh, that's what I'm guessing. So people get
First person
involved
to
in your
get it right.
chance.
How quickly can you Google and put the answer in? Oh,
Yep.
really?
So I
Really got it
think
first.
we got the answer already. So
Google's
Assistant
pulling
Nugget, would you mind
up.
just pausing the quiz? We're not accepting any more answers because I did see the correct answer in the first few ones.
Google's pulling up a lot of 1936s.
Oh, is this because of the 1936 Act?
Because maybe it's because the 1936 Act. I saw an 1884, and I'll give an honourable mention to that. I believe 1884 was the first state income tax that was introduced. I think it was Australia, but I could be wrong on that. The correct answer is 1915. And if anyone wants a bonus point here, why was it introduced? What was the rationale at the time?
Oh, I think someone gave the answer away on the chat already. Yes, that's right. To fund the war. That's absolutely right.
One World War One.
So I don't know, Andrew, if you are able to scroll down in the slides to see who the winner was with the first answer.
I can. I think it was Millie.
All the way down. I think it was one of the first four.
What? Oh no. Tricky
to scroll?
Millie.
Okay then.
Millie.
Yeah. Millie
Rintol.
Rintol. Well, congratulations, Millie. We will reach out to you via email that you registered for this session for. Thank you for participating, people. Better luck next time.
There's more polls.
Yeah.
So don't worry. You still got a chance. The next up is a change to the Medicare levy low income threshold. This is sort of similar to the tax cuts in that this is really dealing with inflation and bracket creep. So to recap, low income individuals, they will either exempt from Medicare levy or they'll pay the levy at reduced rates. There were also increases to the Medicare levy surcharge threshold. This is the low income threshold. You can see there the differences for each of them. There's an increase to the singles, increase to families, and then the various categories, and then your thresholds go up per dependent child as well. So all of those things have increased.
Doesn't this increase every year? Is that right, Andrew? Or every couple of years?
I'm not sure that it's like there's a mechanism in there to do so. I think it actually like action has to be taken to actually increase it.
Yeah.
So moving back to small businesses, the instant asset write-off. This is one which comes up almost every budget, that there's something about instant asset write-off. So, and typically what it is it's this instant asset write-off been extended, which is exactly what this announcement is. So last year there was during the pandemic, there was this, temporary full expensing measures that were pretty much uncapped in terms of what could be deducted up front. And then those ended last budget. The announcement was that the instant asset write-off would be essentially brought back at $20,000, a $20,000 threshold for businesses with under $10 million of turnover. So that would be due to expire as at 30 June 2024. The announcement is that this will be extended by another year. So small businesses under 10 million of aggregate turnover, they can immediately deduct those costs. Whereas if you're not in that category, then you'll be just using your normal depreciation measures. Fun fact, we're actually still waiting on legislation for the current one. And it's proposed that it's actually going to be $30,000 now. So it's maybe we'll get around to actually legislating this at a point in time.
I don't know if it's normal in other countries, but why are we so late?
Oh, it's a good question.
Yeah, no, I'm not. It's a rhetorical
Shouldn't be that
question.
hard for something like this as well. I mean, it's not it's more like it's some complicated, rules that never existed before that have to be drafted. They literally, these exist. You just have to put them back in.
Exactly.
Well, so this is probably the most interesting, what I find the most interesting from a technical and a substance perspective. There's a number of changes announced regarding foreign residents and CGT. And of course, practitioners will know that over the last 10 years or so, there's been a number of different changes to how the CGT rules work for foreign residents. Firstly, they got rid of the 50% CGT discount. There was the stuff around the main residence exemption and being denied. There was the introduction of withholding, foreign resident CGT withholding, and some other changes as well in there. So it's been an area which there's been a number of changes. These ones have stated that these will apply not from budget night, but from 1 July 2025. And there are three measures. So the first one is what's stated in the budget is it will clarify and also broaden the types of assets foreign residents are subject to CGT on. Now, there's no detail about what those mean. Currently, foreign residents are subject to CGT on Australian real property, essentially, taxable Australian real property or TARP, and membership interests in companies or trusts that principally derive their wealth from taxable Australian real property, call it land rich, and then the sale of a business that's carried on through a permanent establishment in Australia, and options and rights in respect of any of those things. There can also be a situation where you have a resident who becomes a non-resident, and there's some deeming rules about the non-resident will still be taxed on all the property they owned when they were a resident of Australia, regardless of whether it's taxable Australian real property or not.
Yeah, it's like an apportionment.
Yeah. It's kind of, you haven't quite left the orbit of Australia, the gravitational pull, so to speak. And when we say taxable Australian real property, it's important to note that that isn't actually just limited to actual residential property, for example. It covers all types of property, and it also covers other things like mining rights and things like that. So it does go beyond just like a narrow definition of property. So I don't know what they mean by clarifying and broadening the types, but that will be a watch this space. What exactly does it mean? Will there be a difference in a foreign resident disposing of some asset before 1 July 25 and after? I don't know yet. We'll have to find out. The second announcement is that there's going to be a change. So in respect of that second category where a foreign resident has shares or units in an entity that is land rich, there'll be a change in the test. So the test at the moment it's a point in time test. You look at if a foreign resident sells shares or units, is the principal asset test failed or satisfied? And that's basically, you got to look at the balance sheet of the company and what its assets are. Where does it get its value from? If it's mainly from real property, then the test is, and vice versa. So there can be a degree of, or an opportunity to change those things if it's based on just a point in time and see that, well, with some planning, maybe there's a transaction 6 months before that has sold something out, which has changed the ratio. So the change is it's going to be a 365-day testing period. Now, again, it doesn't say what 365 days. My presumption is it's the 365 days prior to. Essentially, I think it will be that you actually have to test for that entire period. It means that basically you can't, if it's changed within a year of the sale, it's not going to count. That's essentially my read of that. If it's changed more than a year before, then that opportunity could still be. The third announcement is about a requirement for foreign residents who are selling shares or other membership interests that exceed 20 million. So it's a pretty high threshold. You've got foreign residents selling shares or units over 20 million. They have to notify the ATO before the transaction is executed. Now, why do they have to notify the ATO? Well, I think the reason is knowledge is power, firstly. And why is it before the transaction is executed? Well, once the money goes out to Australia, very difficult for the ATO to recover that. And if you want to do some reading about that, have a read about TPG and the Myer share sale. It goes back 15 years now, and the ATO actually tried to injunct against money leaving the country, essentially. They didn't have a lot of success. This is well before withholding rules exist.
Yep.
Unlike when you sell real property, you've got to get a clearance certificate. If you're selling shares or units, there's no clearance certificates don't exist. So it is somewhat of a self-assessed system. So this requirement will essentially be that, okay, it's a big sale, you got to go notify the ATO. And presumably by notify the ATO, what that actually means is you probably will need to satisfy the ATO that the transaction won't be subject to CGT in Australia because of the underlying assets of the company or unit trust.
Yeah, because there is no CGT withholding on shares and membership interests.
Well, no, there is.
Oh, there is?
If it's land rich, essentially.
Yeah, only land rich. Yeah. But this one is, well, like this new announcement would apply for, not just land rich.
I think it's for any transactions. So the ATO knows about it, and then they can look at it and really determine whether or not there is a withholding obligation before the transaction happens. I don't know what the penalty is going to be for not doing this. I don't know if it's going to somehow invalidate the transaction or what's going to do. So I think this is actually, yes, it's not going to apply to, it's only going to apply to the very big, but it's actually quite a significant change.
Yep. It's basically, hello, look at me, put my hand up, trace through all my entities to see if there are any land.
Next up, we'll be notifying the ATO of absolutely every transaction that the client has done. So they can look at it in advance. But they're not there yet. So yes, as it adds in the budget, this will improve compliance with the rules because, the ATO is going to be looking at it before the transaction is executed. And overall, these measures are expected to increase receipts by $600 million over a 3-year period. So $200 million a year. So that's not nothing. That's pretty significant. It's, billions, but it is still pretty significant.
Mm-hmm.
And there'll be some consultation. The devil's going to be in the detail. It's a watch this space. All right, moving on to superannuation. There's been an announcement about superannuation on paid rental leave. So the announcement is the government will provide just over $1 billion over 5 years to pay superannuation on Commonwealth government funded paid parental leaves. If you're eligible for paid parental leave, that happens after 1 July 2025. Essentially, superannuation will be paid on that as well, whereas at the moment it's not.
This is a positive one.
Based on the super guarantee rate, and that rate's going to be 12% from 1 July 2025.
Great.
There'll be some help for small businesses in administering that as well.
Okay.
So some more superannuation changes. These aren't in the budget, but they're just something to keep. They're in the horizon, just something to keep on your radar. There's the Division 296 tax, highly controversial, particularly around the lack of indexation and the taxation of unrealized gains. And it's still due to come into from 1 July. And that's the additional 15% tax on earnings above a $3 million balance, essentially. And then the payday super, 1 July 2026, employers required to pay super at the same time as their own wages.
No changes there.
HECS and debt indexations. So this is a change to the mechanism around how HECS and HELP debts are indexed because essentially of CPI outstripping wage growth, essentially, is the issue. It's resulting in a situation where debts have increased faster than that they've increased faster than the wages have gone up. So essentially the announcement is that the indexation will be limited to the lower of two things, CPI and wage price index. That will be applied retrospectively, subject to the passage of legislation, and it results in a saving of around $3 billion.
Oh. Andrew, you just gave away a quiz.
I did. No.
We'll skip it then.
They're excited. That means that I win.
Know.
That means that I win the
We'll give you a mug anyway. But yeah, looks like Andrew has won this quiz. So unfortunately, he's taken your chance away. But we have one more quiz at the end. So stay tuned.
So yes, sorry about that. So the government estimates that this will cost $3 billion.
It's a huge one. Yeah. So I think it's a really positive change.
That's it. Rise respectively, reduce outstanding loans by $3 billion. All right, moving on to digital ID. Announcement is that the government will provide $288 million over 4 years to support a initial delivery of the digital ID system. I actually don't know what this actually going to do. Being honest, I don't know what this is actually. I don't know what the digital ID system is. I don't know how it's going to build it. Anyway, about it, feel free to add them.
Well, if it's as fun as the MyGov and Director ID system, I'm really looking forward to it.
We're going to be in for lots of fun.
Yeah.
And there's funding around to continue operating and improving the government's digital ID and MyGov ID systems. So some more miscellaneous measures. There's energy bill relief. This is the $3.5 billion over 3 years for cost of living relief. It's a $300. How it works is it's a $300 rebate for Australian households. Now, from what I was reading, this is essentially would be applied directly against power bills. I don't know exactly how that happened, but it's directly against power bills on a quarterly basis. And the eligible small businesses, which is not defined what that is, there's a $325 rebate. They don't sound like big numbers on this, on the face, $300, $325, but when you apply something to everybody, it works out as a big figure. That hence the $3.5 billion. I did read some economists criticizing this measure as being, it says that we're worried about inflation, but giving all households $300 doesn't help with inflation. It just gives everyone extra money for the same issue. It's there. There's also an announcement about modernizing digital assets and payment regulation. This is about, it's a relatively modest sum for consulting and developing legislation to license and regulate platforms for holding digital assets, tokens, decentralized finance, and also introducing a new regulatory framework. I don't know how they're going to do that with $7.5 million, but we'll see.
It's not a lot, is it?
Not a lot. It's not a lot. Made in Australia, or future made in Australia. When we were putting together our own Velocity Legal budget update last night, we were criticizing the name a lot. It kind of doesn't grammatically stick very well. Future made in Australia. It's actually just not proper English. But anyway, that's the tagline, future made in Australia. This is essentially, it's interesting from a policy perspective because, there's different schools of thought on economic policy. Okay, should we just let the free market determine what's best? Or should we pick winners and provide subsidies for things? All countries have done different things at different points in time on this. But essentially, this is moving, it's that sort of trying to pick things that we want to promote as a country and to incentivize those things. So this is about trying to sort of pick out some key manufacturing related issues for the modern or the green economy, and sort of back those basically. It's about renewable energy. How the wording is making Australia renewable energy superpower, but it's focusing on investment through hydrogen, green metals, low carbon, clean energy technologies, development of skilled workforces around those things. There's things around environmental approvals and funding to essentially fund some of these things, and also to regulate, I guess, what's called greenwashing, which is essentially claims that something is environmentally friendly, but maybe it's actually not. So the interesting thing here is that this is actually, in terms of dollar figures, it's reasonably substantial. The agenda is over $20 billion over 10 years. And while you might think that that's a lot, if you're interested in looking at this, have a look at what the US has done. The US has committed $1.6 trillion to essentially measures related to this. So solar panels, greening the economy, competing with mainly China with clean energy manufacturing. And from what I was reading, they've spent about $200 billion of it. And the existing president is trying to spend a lot more of it before the next election to sort of try to leave a legacy. The numbers actually really pale in comparison to what the US is doing. But, and it's been commented on that in a couple of articles I was looking at in the AFR that, okay, you might question whether picking winners or not is a good idea, but it's actually not a lot of money. So $20 billion sounds like a lot of money. But in the scheme of what other places are doing, it's actually probably not enough to change anything. I'm just reciting what other people have said.
But the headline sounds good.
Yeah. Other than
even if it's grammatically not quite right.
So what's not in the budget? A lot of things, because there wasn't really much of technical changes, but Division 7A reform, I talked about it for so long now that it's...
Give it up, Andrew. You keep having this slide here. I would have taken it out years ago.
No, I'm going to keep having it in, you know. There's nothing about Bendel or UPEs or anything like that. The tax residency rules, I would have expected. I was kind of expecting there would be something. For those that aren't familiar with this, there's been problems with the corporate residency definition going back 7 years now. Government was announced that they were going to change the law because essentially there was a court decision which interprets what's an Australian resident, like where a foreign company could be an Australian resident, and one lot broader than was previously thought. But nothing's been done, and I'm kind of concerned that kind of getting close to the situation now where the ATO has just got to have to administer the actual law rather than some prospective announcement. Hasn't come through yet. And for individuals, there's a lot of work being done around a proposed model around codifying the tax residency rules. And the government's previously stated that they were committed to doing those things, but again, no updates about those. There's been reviews about CGT rollovers. They haven't gone anywhere. Nothing with small business concessions, including the actual concession, the small business restructure rollover. They're all staying exactly the same. Nothing about everyone's favorite topic, Section 100A, still all there. All the taxation of trusts more broadly and kind of how many holes there are in that, or any other previously shelved policies. We all get articles every year about restricting negative gearing, changing the 50% discount. There's nothing about any of those things. Not actually a lot. You can see there's quite a lot of things that still, there's problems and issues, but none of them are in the budget. All for new elections. Yes. Yep. We have a final poll and a Q&A. Is a poll after?
Yeah. So any questions, keep them coming. I do see there's one in the Q&A, and I've just sort of been looking at the chats as well. But one question is about the energy relief fund. Is that going to be means tested at all? No, it's just everybody.
Yeah, and you could see why that's, like if someone. I think that, we're providing cost of living relief. It should be for the people who need it most. So no, it's not means tested. It's for everybody.
Yep. And then somebody else commented or asked as well, like, what is an eligible small business to qualify for that energy relief? Because you imagine there'll be some sort of, like you can't double dip kind of thing.
Well, I think you probably can double dip, but it depends. If your business is at home and you're a sole trader, maybe that is double dipping.
Yeah.
But if you're a company and you have an office, then that's not double dipping. It doesn't say what the definition is. It could be 2 million turnover, it could be 10, it could be not sole traders. Don't know.
Yeah.
But it's designed to be household by households. I would think that if someone doesn't have like a fixed operating place business, it's probably not appropriate that they're getting that $125.
Yeah. I think it's got to be under a company's name anyway. If they're doing it via people's electricity bills for the individual one, then I imagine.
That's the point.
Yeah.
Yes.
Yeah. So I think, we'll see all our electricity bills starting 1 July go down by $75 a quarter.
Yeah. And I think there's another question that came through. I think my understanding is this is applied automatically. And then, I mean, the one good thing about not means testing someone is that it actually makes administration of it extremely easy. Basically, all the power companies just reduce the money off your bill and get it from the Australian government instead. And where they get the money from, they get the money from you.
Yeah.
It's, I think it'll be hopefully easy to administer. Like, people don't have to do anything. I remember there was, going back to the GFC, for those that remember, there was, I think it was it $800 or $900? There was like a big handout, but it came into your income tax. And then there was a big rush of people to lodge their income tax returns, because if you had outstanding income tax returns, then lodged, you can get it.
Mm-hmm.
There won't be any of that. Right.
Yep. It was the GFC time, I think.
Just after the GFC.
Yeah.
Yeah, just in the GFC. Yeah.
Mm-hmm. Mm-hmm. Great. Any changes to FBT at all? Maru has asked.
No.
I didn't see anything either. Any more electric vehicle subsidies? Somebody else has asked.
No, I know
some
state governments have that. I don't think Queensland's pretty generous. But no, nothing in there about those.
All right. Okay, we're almost out of time. We've got one more quiz left, but before we do the quiz, let's launch our ratings poll. Assistant Nugget, please let us know, how you thought today went. Leave us a comment as well. Thank you. And then, if you can go to the next slide, Andrew, we can do the quiz too. So giveaway time. Opportunity to win this limited edition personalized mug that we will
I'm going to make up for the other one that I ruined.
Okay, if you want. Yep. So Andrew will pick two of his favorite. But what was your key takeaway from this year's budget? Put it in as creative as you want to be to grab Andrew's attention. It has to be on Slido, people, so that we can look out for it.
The Albanese. Oh, I didn't know he was listening.
What? What's a snafu again? Is it rude? All right, people, thank you. Keep them coming. Andrew, any top picks yet? Not yet. So keep them coming then. Andrew hasn't seen one.
Lots to choose. So some good ones.
Oh, okay. So snafu is defined as situation normal all F up.
Try to not be political. I think I really like the get a government job ones.
I
think I'm going to give one to Harmon. Just another year of waiting for bigger tax reform.
Well done, Harmon.
And I'm going to try to get. I'm going to go election year means free electricity. Yes, I can't help it.
Well done, Shane, Bailey, Michelle. Reach out to you both later via your email and get your address and we'll ship the mugs to you. Amazing. Thank you very much for participating, people. And what else do we have? We've got one more poll before you go, which is, can you let us know where you first heard of us? Just to help with our marketing. Thank you very much. And Andrew, what was your final key takeaway?
Look, I think I'm a tax lawyer, so I'm not less interested in energy bill rebates and more interested in technical changes. So I think my key takeaway is the changes around foreign residents and CGT. I think that was genuinely going to be interesting and would change things for where you are dealing with foreign residents selling assets, particularly shares and units. So that's my takeaway of actual substantive changes. Outside that, there isn't a lot.
Yeah. And one comment about tax reform from you before we go.
Good luck with it.
But fine. Yeah.
Doesn't seem to be any desire on any part of it. So
Yeah. All good. Thank you so much, Andrew. And thank you, everybody, for joining us. If you found today's session insightful, please do check it out, taxnuggetsacademy.com.au. All right. Thanks, everybody. Please put your emoji hands together one last time to say thanks, Andrew. Bye.
thanks.